Good day to all of you tuning in. I am Dr. Samuel, and today I'll be guiding you through some of the most effective tax-saving strategies that every investor should know. In the financial world, taxes are a certainty. However, with a well-planned strategy, we can turn this inevitable expense into an opportunity. Understanding tax-saving strategies is crucial for every investor, as it allows us to not just save money, but also to optimize our investments for maximum growth. Whether you are a seasoned investor or just starting out, these strategies can help you make the most of your hard-earned money. They can help you reduce your tax liability, increase your net income, and ultimately build a stronger, more resilient financial future. Remember, tax planning is not just about saving money, it's about making your money work for you. Before we dive into strategies, it's crucial to understand the basics of taxation. Now, when we talk about taxation, what exactly do we mean? Well, in the simplest terms, taxes are mandatory contributions levied by governments on individuals and corporations to fund public services. Let's start with income tax brackets. Imagine these as a staircase. The more you earn, the higher you climb on this staircase, and the higher the rate of tax you pay on your income. This is what we call a progressive tax system. It's designed to distribute the tax burden fairly, so those with the highest income bear the biggest share. Next, we have deductions. Think of these as discounts on your taxable income. They reduce the amount of income that's subject to tax. Common deductions include expenses related to education, home mortgage interest, and contributions to certain retirement accounts. Then come exemptions. These are amounts subtracted from your income for specific situations like having dependents. However, it's important to note that tax exemptions have been largely replaced by increased standard deductions under the current tax law. And finally, we have credits. If deductions and exemptions are discounts on your taxable income, credits are like coupons that reduce your tax bill directly. They come in many forms, such as credits for education, energy efficiency, or child and dependent care expenses. It's also important to understand tax laws and regulations. These are the rules of the game. They're complex and often change, but understanding them is key to strategic tax planning. These laws define how different types of income are taxed, what deductions and credits are available, and when and how you need to file your tax return. With a solid understanding of the basics, you can now start to strategically plan your taxes. Remember, knowledge is power. And in this case, it's the power to potentially save you big bucks on your taxes. So let's dive into some strategies that can help you do just that. Stay tuned. Our first strategy involves making the most of tax-advantaged accounts. These accounts are like treasure chests for your money, shielding it from taxes while it grows. The most common types are 401(k)s, individual retirement accounts or IRAs, and health savings accounts, also known as HSAs. Contributions to a 401(k) or an IRA can reduce your taxable income, meaning less of your hard-earned cash goes to taxes and more stays in your pocket. In fact, if you're in the 25% tax bracket and contribute $5,000 to your 401(k), you could save up to $1,250 on your tax bill. Health savings accounts, on the other hand, offer triple tax advantages. Contributions are tax-deductible, the money grows tax-free, and withdrawals for qualified medical expenses are also tax-free. In the grand scheme of things, tax-advantaged accounts can be a powerful tool in your tax planning arsenal. Next, let's talk about how long-term investments can lead to tax savings. Now, you might be wondering, what exactly does long-term mean in the world of investments? Simply put, a long-term investment is one that you hold on to for more than a year. But why does this matter from a tax perspective? Well, the Internal Revenue Service, or IRS, categorizes capital gains into two types: short-term and long-term. Short-term capital gains from investments held for a year or less are taxed at the same rates as your ordinary income. This could be as high as 37%. On the other hand, long-term capital gains from investments held for more than a year are taxed at a significantly lower rate. In fact, the maximum tax rate on long-term capital gains is only 20%, and for some investors, it could be 0%. That's quite a difference, isn't it? This is where the beauty of a buy-and-hold investment strategy comes into play. By holding on to your investments for longer than a year, you are shifting your capital gains from short-term to long-term, thus potentially lowering your tax liability. Imagine this scenario. You're a savvy investor who's purchased shares in a promising company. After a few months, the shares have appreciated, and you're tempted to sell and take the profit. But wait, If you hold on to those shares for just a little longer, crossing that 1-year mark, your profits from selling the shares will be considered long-term capital gains, and you'll be taxed at a much lower rate. But remember, while taxes are important, they shouldn't be the sole driver of your investment decisions. A buy and hold strategy also requires patience and a solid understanding of your investments. It's about making informed decisions and having the discipline to stick to your investment plan even when the market gets tough. So, as you can see, the world of investing isn't just about picking the right stocks or timing the market perfectly. It's also about understanding the tax implications of your investment decisions. Remember, patience in investing can not only yield higher returns but also significant tax savings. Another effective strategy is to leverage tax deductions and credits. These little gems in the tax code can significantly reduce your tax liability and should not be overlooked in any savvy investor's tax strategy. Let's start with tax deductions. These reduce your taxable income, meaning you'll owe less tax overall. Common deductions available to investors include the interest paid on loans for investment properties, expenses related to managing those properties, and even the depreciation of your investments over time. For instance, if you've taken a loan to purchase an investment property, the interest on that loan is generally tax deductible. Similarly, any expenses incurred in the maintenance and management of your investment properties can also be deducted. This includes things like repairs, insurance, and property management fees. Depreciation is another interesting deduction. As an investor, you can write off the declining value of your investments over time. This is especially relevant for real estate investors, as properties tend to depreciate over time. Now let's shift gears and talk about tax credits. These are even more potent than deductions as they reduce your tax bill dollar for dollar. If you owe $2,000 in taxes and you have a tax credit of $500, you now only owe $1,500. There are many types of tax credits available to investors. For instance, there are credits for energy-efficient improvements to rental properties, and even credits for certain types of investments in specific industries or areas. To fully capitalize on these deductions and credits, it's vital to keep meticulous records of your investments, related expenses, and any potential credits. A qualified tax professional can be an invaluable resource in navigating these complexities and ensuring you're maximizing your tax-saving potential. By strategically leveraging deductions and credits, you can drastically reduce your tax bill. Remember, every dollar saved in taxes is another dollar that can be reinvested to further grow your wealth, so don't miss out on these opportunities to maximize your investments and minimize your tax liability. We've covered a lot of ground today, from understanding the basics of taxation to exploring 3 powerful tax-saving strategies. Let's quickly recap what we've learned. First off, we delved into the nitty-gritty of taxation, highlighting how understanding the tax system can set the foundation for effective investment planning. We shed light on how your investment decisions can significantly impact your tax outcomes, a crucial consideration for any savvy investor. Next, we unfolded the magic of tax-advantaged accounts. If you recall, these accounts offer unique tax benefits, shielding your investment earnings from immediate taxation. And who wouldn't want to keep more of their hard-earned money? Then, we brought your attention to the power of long-term investments. We discussed how capitalizing on the preferential tax rates for long-term capital gains can lead to substantial tax savings. It's all about playing the long game, isn't it? Finally, we ventured into the realm of tax deductions and credits. We emphasized how leveraging these can significantly reduce your tax liability. Remember, every dollar saved in taxes is another dollar working for you. In all, we've seen how strategic tax planning can be a game changer for investors. It's not just about making money, it's about keeping as much of it as possible. It's about making your money work harder for you. That's the essence of smart investing, so take these strategies, apply them, and watch your wealth grow. And remember, knowledge is power. Stay informed, stay ahead. Before we wrap up, a quick reminder, if you found this video helpful, please hit that subscribe button, give us a thumbs up, and share it with your friends. Your support helps us create more content like this. I'm Dr. Samuel, thanking you for joining me. Remember, with effective tax planning, you can make your money work harder for you. Don't forget to subscribe, like, and share for more insightful videos like this one.